Hey, good morning, everybody. Hope your Saturday's off to a good start. We got cold and rainy here up in Maryland, so that's always fun. I guess it's not bad when you're going to be in the office working on Saturday, so don't really need great weather. Anyway, I'm on a new computer, so if the sound or the video looks a little different, let me know if it's not working or something like that. Throw it in the chat box. So I might look a little weirder than normal, maybe. I don't know. I think the camera's working pretty well, but we'll see. Anyway, so today, a little bit shorter. I was traveling this week and really busy week, and but have a few questions from you all, and also ran across. I'm going to start off with something I ran across and just some conversations. And when I hear it from 2 or 3 clients, at that point you start to wonder, like, what, there's something going on here. It's kind of weird. Anyway, so yeah, I'm in the office doing taxes, and I wanted to start off talking about that. If you didn't know, I've got a tax office associated with the planning. I started the tax office. So I started my planning firm in 2006 and then did the tax office in 2014, I think it was. So it's just been too much on the tax side. It's just too much now. It's too crazy. I got tired of having to work till 9 p.m. And the thing is, the governments, IRS and states, just the number of letters that are coming out. So the things you have to deal with that you shouldn't have to deal with. It's too much. So I know quite a few clients, quite a few folks do their taxes through us. So basically what's happening is there's a CPA firm that's buying my practice, and they're going to basically keep it exactly like it is. So if you come to the office now, you picket fence tax, it's going to be picket fence tax. They're just basically stepping in. At first, I thought they were going to move people over to their office and move it into, his name's David Bryant, move it over to David Bryant CPAs. But I guess they kind of like the branding we did, the look and feel of the office, everything like that. So they're going to keep it exactly the same. So the only difference will be I'm not going to be doing taxes. So this is my last season doing it. They're going to take over in June. So at that point, I'm kind of stepping away and they're stepping in. So if you're already a client using us for taxes, I'm really hoping you'll continue. Pretty much everything's going to be the same, except I'm going to be removed. Now, the nice thing is, if you do your taxes here, I'm still there. We've kind of arranged it to where I'm still going to have all that information for my planning clients, so I can still do all the tax planning, all that good stuff. So there's still going to be a lot of synergy between the planning and tax side. It's just they're going to own the tax side of everything. So it's again, last season doing this, and then after that, I'm just going to focus on the planning side. And I think I've been talking on this about my next move for the planning side. So it's looking more and more like I'm going to merge in with Cale Smith. I did an interview with Cale a few months back, I guess probably 3 months back. But Cale and I have known each other since July 7th, 1990. And I know it's probably weird to know the exact date, but he and I went to the Coast Guard Academy together. So that was our swearing in day. So it's pretty easy to remember when we met. And he and I were in our, we called it Swab Summer, basically our boot camp. We were in the same platoon, so we got to know each other from then. And then we were stationed in Hawaii together. He was on one ship, I was on another. But we actually, me and me, Cale, and 3 other guys were roommates in a house. So So I've known Cale forever, know him really well. And I'll talk more about everything on that, but I'm just trying to keep some nuggets out there for everybody, just to see, kind of what's coming down the pike. So anyway, all right, let me jump into our presentations. We always do. And this will be, again, a little bit shorter than normal. Okay. So I'm starting off today, kind of a weird thing recently. So I was talking to one client, and we were just chatting, and he talked about how he had some fraud with Medicare. And he said that, they had basically charged Medicare for, I think it was like $200 a month catheters. And I thought, wow, that's awfully weird. But, he caught it, called Medicare, reported it. And then I had another client basically say the same exact thing. And it was just through general conversations. And then another person who I work with, who brings her clients to us for taxes, was saying that she had a client that had the same thing, catheters, and hers was like $16,500 in catheters she didn't need. And I'm like, that's just weird. So I thought I would dig in and see a little bit, because I know a lot of you watching are either on Medicare or getting close to it. So I kind of dug around and found out, there was a Medicare hack a few months back. It was discovered, I think, in August of 2023. And it was through, one of the providers for Medicare, one of the informational organizations that they use. And, basically this hack disclosed information on 600,000 Medicare beneficiaries. And, and they got a lot of information. They got all their Medicare stuff, their name, their address, everything along those lines. So I'm pretty sure that this thing has been associated with that. So the folks that were subject to that hack are now seeing some weird things. So if you're on Medicare, you definitely want to kind of stay alert to the billing to see if you're being, charged for services or equipment that you never received or you don't use. So the big thing was COVID-19 test kits, and then self-catheter kits are two of the things that, when I was researching, are probably the biggest areas that you might see. So, if they threw one COVID-19 test on a bill of yours, you may not catch it. But if they throw $16,500 of catheters, you're probably going to catch it, or 1,000 COVID tests or something like that. And the people that are doing this scam are pretty attuned to how Medicare works. So when you do a procedure with a doctor or any kind of medical professional, they technically have 12 months to bill for your procedure. So they have time. So I guess what these scammers are doing is, the procedures happen, they wait a while, and then they tie COVID-19 test or catheter test to something that you had. So if you've had surgery recently, you might want to be alert, because what might show up within the next 12 months is COVID-19 tests or catheters. And they'll date it back to that procedure that you needed it for, whatever procedure you had done. So it's something to kind of be alert about and watch for. I thought it was pretty interesting that we're starting to see that. Usually when I get 2 or 3 clients that tell me something, I think I know there's a bigger trend. So I have a feeling there's probably people watching this who are on Medicare that have been charged this and maybe haven't reviewed it, because it's something that kind of slipped past the goalie, because maybe you had something done 6-8 months ago and you think that all the bills are done and settled, but it probably might not be. So, the big thing, if you think you might be a victim, first thing is, never, whatever you do in any situation, never give personal information over the phone, unless you made the call and you know who you're talking to. If somebody calls, I don't care what it is. If they're asking for personal information, you feel like you should give it to them, like Medicare, Social Security, something like that. Just say, well, can you give me a number? I can't talk right now. Can you give me a number? I'll call you back. They're not going to give you a number. So that's a quick, easy way to do it. Or you can just hang up if they're asking for that. Don't stay on the call too long, because they're going to try to convince you that they are, in fact, from the government organization that they're trying to call from. So you need to remember, Medicare basically is going to contact you through the mail. They're not going to be calling you. Same with Social Security, same with the IRS. They don't call you on that stuff unless you know the call is coming, unless something has been set up as far as a meeting. Another thing, if you see some charges or something seems a little off, a good starting point is to go to the Better Business Bureau. They have something called the Scam Tracker. It's just bbb.org/scam tracker. And you might see if there is something that other people have been subject to. It's kind of a place where a lot of people go, put this out there when they find out that there's been a scam. And then obviously, if you see something on a Medicare bill, call Medicare. If you call them directly, you can report this stuff. And obviously, you can also clean up your record. So yeah, it was just kind of odd that all of that happened, that I hear these stories in such a small time frame. So I think it could be something that's coming up. Maybe whoever these scammers were basically started for all these people that got hacked at the same time. That could be something that's happening. I don't know, but I'm just trying to alert you to it. And then I guess it's always a good time to just go over some general identity theft tips. First off, like I already mentioned, never give your information over the phone unless you made the call, unless you know who you're talking to. Another thing is to put a freeze on your credit at the 3 credit bureau agencies. So TransUnion, Equifax, Experian, you can do this online. It's just called a credit freeze. So basically it locks it up. So if anybody tries to run a credit on you, a credit history, anything like that, it's going to come back and say that none of that information is valid. And what that does is anybody that tries to take a credit card, a car loan, anything out in your name, if they're buying from somebody reputable, they're going to want to check your credit. And when they don't get any credit information, they're not going to allow the person to get the loan. Now, the beautiful thing is they used to charge $5 anytime you put a credit freeze on or whenever you pulled the credit freeze off. Now it's free. Government's mandated that is free. And the nice thing is, let's say you freeze your credit and you're going to get a car loan, basically what you do is you just call up the car loan, who's ever lending, say, okay, who do you work with? Is it TransUnion, Equifax, Experian? Sometimes they work with one only. Sometimes they work with 3. And then you can go into those sites and you unfreeze it. And you can unfreeze it for a few days. So if you know that they're going to check your credit on a Wednesday, you can on Tuesday unfreeze it and then have it go back into effect on Friday. So it's really getting much easier to use this thing. And it's just a great way to protect your credit. If you have children that are under the age of 18, it's a good idea to freeze their credit, because that's another area where scammers will go, because if they can open up credit in your child's name, you might go years, maybe even a decade or more before you start to look to open credit in your child's name. You find out your child's credit is atrocious because people have been using it. So that's another thing to think about. Of course, the other big things, you always want to have your antivirus and firewalls active and working on your computers. You want to do your updates to make sure that you've got all the security breaches filled as soon as the Microsoft or Apple or whomever it is, once they discover it, write the code to fix it, you update it. The other thing I usually recommend, especially, this isn't critical if you're on your own home network per se, but if you're traveling, absolutely, you want to get a virtual private network, a VPN. There's a lot of providers out there that are really good, but what that does is it kind of blocks the traffic. As you're going online, if somebody were to hack your system, they wouldn't be able to see where you're going online, and they wouldn't be able to see the information that you're putting in there. So it's not a bad idea to do it at your home either, just in case for whatever reason somebody was able to hack into your Wi-Fi. So it's not a bad idea to think about that. And the last thing I tell clients all the time is look to get some sort of password protector. Like right now, I use 1Password. Now there was a hack. I can't think of the one that I was using before. Didn't really get into give password information, but there was a little bit of a breach. So switched over, changed all my passwords, switched over to 1Password. It's a very highly rated password protector, but basically all this does is creates an encrypted database with your passwords. And so what it allows you to do is for you to create extremely random and 18, 21 digit passwords for every site. So if they got the password to one of your sites, it doesn't mean that they could go to lots of other sites and use it, because so many people use the same password at several different sites. And if they get your password for Bank of America, well, they'll go to all the other brokerages and banks and test that password out. And sometimes they might get in there as well. So at least with this, you're going to create a really secure password, completely random, something you're never going to be able to memorize. And the other thing is, it's protecting those passwords. You never want to save your passwords in your browser. A lot of times Safari, Chrome, Windows Edge will ask, you want us to remember this password? Don't do it. Don't do that, because that's an easy thing to hack. Getting into the browsers is very easy to hack those. And then once they hack into your browser, then they've got access to basically everything at that point. So you really, really, really need to think about that. Great point here from Rob. Scammers are using text now. Absolutely. Yeah. So it used to be most of this was focused on your computers, because that's really where most people did their online traffic, was on their computer. But now most traffic is done via your phone. And you've got the Apple iPhone, iOS, and then you have the Android, which are the two largest systems that are used on cell phones. And yeah, they're trying to hack into that. So same thing applies, all that stuff. Don't remember passwords on there. All that I just talked about for your computer, you want to make sure you're doing that for your phone. And you can put a VPN on your phone. You can obviously put some antivirus on your phones, things along those lines to help protect your phone, because they're just as vulnerable as your computer. Okay. So we're going to just do something real quick. Last time I did the presentation, we talked about some of the moves I'm starting to slowly add back in. And a lot of it's just focused on heavy value stocks. Stop this for a second. I'll show you a video. But focus on value. Growth is just, it's been just nutty how like on the Magnificent Seven. We're going to talk a little bit again about that. But, my big thing is, as an investor, you have to think about, or at least all the, the ways they teach you in your CFP coursework and your finance classes at college, all that good stuff. The biggest thing is, what kind of return you're going to get. And that is, how much cash are you going to get? If you buy a rental property, if you're going to buy a small business, if you were going to buy a franchise, something like that, you want to know, okay, I'm giving you X amount of money. What kind of cash am I getting back? And we've sort of deviated considerably from focusing on cash flows to just focusing on growth, revenue growth, or the hot story. And the reason that happens is when money becomes cheap, when rates drop to near 0%, when money's cheap, you don't really necessarily worry about cash flows because there's unlimited access to capital. So you can invest in companies that don't show profits, that don't have positive cash flow, because they'll say, well, we're growing. Okay. And they have access to capital to continue to build their plan and grow. Now, it works out a lot of times. Amazon they didn't show profit for over 20 years. They take the capital that they had and capital that they borrowed, and they would use that for growth. And they said growth would come down the road. Now they're starting to show profits, but it took them a long time to get there. So a lot of companies, they do need that kind of runway. And the problem, though, is when interest rates are really low, that runway is much longer for companies than it probably should be, and more companies get access to that runway. So I've been thinking that with rates jumping up to where they are, pulling the short-term federal funds rate up over 5%, once you get to the point where you could invest in T-bills and get 5% or better, you start to go, well, I need some cash flow from my other investments too. That's usually where you start to find the story stocks, the hot stocks, things like that fall apart because they're not producing cash flows. And then their cost to borrow goes up, which further hampers their cash flow. That's typically what you see. And we saw a little bit in 22, but then 23, it went back to almost as if there was just massive amounts of liquidity, and most of it showing up with those 7 stocks. So I got a quick little video. This is just really short. And what this is just talking, go to kind of the maestro of cash flow investing, Warren Buffett. Everybody knows Warren Buffett, but what makes him so successful is he just does an unbelievably good job of understanding what the intrinsic value is of a stock. What cash am I going to get from this company for my investment? So this was a lecture he gave at a university. And I'm just going to show you a couple minutes of it. That's really all you need. He kind of explains his process. So let me just show the video, and then I have to jump to where it starts.
Okay, here we go. In this video, I'm going to take the time to explain exactly how Warren Buffett calculates the intrinsic value of a stock. We'll hear him explain it's 3 minutes long, but really listen to it. And also don't worry if you don't understand it immediately. We'll come back after and we'll run through a full example of the method he's about to explain. Over to you, Warren.
Is how do you find intrinsic value in a company?
Well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change. But the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, isn't the question about how many analysts are going to recommend it, or what the volume in the stock is, or what the chart looks like, or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock.
So if your company was selling for a market cap of 100,
Okay. So hopefully this video will leave here. Okay. Had a little trick to get to the right spot, but that I always found that short video is probably one of the best I've seen on really how you want to look at investing. It's kind of how I've always tried to look at it. So when you look at some of these, the stocks that we have that are going crazy right now, so the six, 7 stocks, valuations kind of tell you what your future return is going to be. Now, Buffett talks about this discount rate, and that is a factor. What that basically means is you look at what's the growth rate of their earnings, of their revenues, and things along those lines. That certainly plays an enormous part in the investing equation. But that stuff's unknown. I mean, it's really unknown. There's a lot that can go wrong with that. So if you can look at what their actual cash outputs are, you have a better understanding of what you're going to get as an investor. And I just feel like, we're going to talk NVIDIA here in a second, but with NVIDIA, it's trading at 40 times their sales and over, I think 125 times their earnings. So, I mean, that's just absolutely ludicrous. So if their revenues don't grow at all and earnings don't grow, it takes you 40 years to get back your initial investment based on their revenues, or it takes 125 years if you're looking at earnings. Now, they are growing, and they're growing rapidly, but still, how fast are they going to grow, especially considering they're already close to a $2 trillion company? How fast can a $2 trillion company actually grow? And it comes back to, when you first start a business, if you have one client and then you get one more, that's 100% growth. And then it takes you need 2 more clients to get 100% growth, and then 4, and then 8. It gets harder and harder to scale that for any business. And when you get to be 2 trillion, to scale that to 4 and then to 8, and then, that's a big task to be able to do that. So let me jump back into the presentation real quick. And I've shown deviations of these slides previously, but what we've got is just a really, really concentrated market where only a handful of the stocks are essentially, they are the stock market right now. This shows we talk about the Magnificent Seven, and their size is, bigger than the stock markets of the UK, China, France, Japan combined. Is it worth that? I mean, maybe, but there's an awful lot that can go wrong when you have so few stocks carrying everything and reaching that kind of valuation. So, I've been talking about energy for quite a while here, a few months, couple of years, really since, the price of oil per barrel went negative back in 2020. And you just kind of look at sort of market cap here of Microsoft versus the entire energy sector, the S&P 500 energy sector. And you can see it's, the market cap of Microsoft is almost 2 times that of the energy sector. But if you look at the annual cash flows, the energy sector is providing twice as much cash flow. Now, for a company as big as Microsoft to be able to double their annual cash flows, their revenues, their earnings, that's an enormous undertaking. You either need to find a new product that's never been involved and has absolutely zero competitors, or it's going to take time to get there. So you have to say, if you were going to, if you had $1.6 to $3.1 trillion yourself, which one of these would you invest in? Like, where are you going to get your cash back? So again, there's always these great charts that try to say, are we hitting another tech bubble like we did in 2000? This is a chart comparing NVIDIA from 2020 to today to Cisco, which was kind of the poster child back then. And, Cisco has been stagnant for years and years, even since the year 2000 crash. But it's a great company. It produces tons of revenues and earnings, and it's a very good company. But it just got so far ahead of itself, despite being a clear leader in networking around the world. But now, I also say you have to be careful when you look at charts overlapping this stuff. You think that it's going to be precise. Here's another chart. This guy did the NVIDIA versus Cisco, and he's saying, hey, we still have about a year and a half left, and NVIDIA could triple in size to get to the same level of Cisco. So you don't want to look at charts like this and say, oh, it's going to happen. This is exactly, you're just trying to find trends with this stuff. But the trends, it all depends on the information that you use. But what I say is, okay, on the left here, we have Cisco. On the right, we have NVIDIA. When anything goes straight up like this, when it's just going up, you got to wonder, it's certainly not based on what we call fundamentals. It's animal spirits. And the thing about animal spirits is they're very fickle. Fundamentals, it's hard to break down your fundamentals, without doing something really stupid like lawsuits or, horrible management, something along those lines. I mean, you could look at companies that you thought would never go away that are no longer in existence, Sears and Woolworths and all those things that were absolute bellwethers. But you'll just look at this thing and you go, man, how much further straight up can it go at this point? Like it is. And again, NVIDIA is a phenomenal company, absolutely phenomenal. And they do have basically a technology, their ability to develop the AI semiconductors. Right now, there really isn't any close competitors. But that gets back to my point. Like if somebody has a product like that, it's going to draw competitors at some point. And I'll show you real quick. This is just comparing NVIDIA to Exxon. So Exxon's the largest oil company out there. But you can kind of see market cap. Exxon's worth about $400 billion. This is a little bit dated. NVIDIA's worth 1.8 trillion here. It's even closer to 2 trillion now. So you can kind of see based on the market cap. But here's the revenue. So if you invest in Exxon, they're producing $334 billion of revenue, and they're worth $400 billion. So really only a little bit over, say 1.5 times revenue. NVIDIA at 44 billion, we're talking 40 times revenue. Now earnings a little bit better here. NVIDIA has had a huge spike in their their earnings up to 18 billion, but it's still only half of what ExxonMobil is. Now, granted, if they doubled here in the next year or two, they'd be where Exxon is as far as earnings. And the reason their earnings are so good, I mean, they only have 44 billion of revenue, but their bottom line is 18 billion of profit, which is very good. You're getting close to over 40% profit margin, which is phenomenal. Well, but again, when you get to 40% profit margins, you're going to draw competitors. And how do competitors usually come into the market? They come in and they lower the price, right? They have to entice people to look their way. So if Intel decided to do chips that are AI, they could come in. They've got a huge amount of money that they could put towards research and development, and then they're going to undercut NVIDIA. And it doesn't take much to start to undercut them. If the chips are of, say, close to equal, capabilities. And one more kind of NVIDIA, this is comparing them to the entire energy sector, the S&P 500 energy sector, which is XLE for ticker symbol. And you can kind of see all of those companies have a market cap of 1.5 trillion. And again, NVIDIA at the time of this graph was at 1.8 trillion. You can get closer to 2 trillion. But if you look at the net income, so the energy sector has produced $147 billion and NVIDIA is at 19. So again, where are you putting your cash? And the thing is, I have no idea how long this goes for. You go back to the tech bubble 2000, it went on for longer than people think. But you're probably heading for a buzzsaw unless truly this time is different. That's the only way this stuff really makes sense. This is just one more graph just showing information technology in general relative to energy as far as how much, what percentage of the S&P 500 does it make. So when you buy an S&P 500 fund, you're basically 31% in information technology, whereas the S&P 500's only got about 5% allocated towards energy, despite the fact that it's so darn profitable. The thing is, you're starting to see it, it's hitting the retails. Retail people are jumping in on it, and I get questions on it all the time. And from clients, why aren't we doing these focused on technology stocks? And I try to bring this stuff up. But even some of the biggest pension funds are now, jumping into NVIDIA and semiconductor stocks in general, putting large allocations towards it. So, you got to wonder, are we getting close? This is the California system, California pension system. And even worse is they're starting to add more leverage to it. So they're actually borrowing money to invest in some of these stocks in derivatives. So it's getting a little frothy, but there is still room to go. This is margin debt. So margin debt is when you borrow money to invest in stocks. And typically at the peaks, you see this number hitting kind of high. So you can see in 2022 was the last sort of peak that we had on that. So we're still below the 2022 peak, although this is going up rapidly. As I just said, pension funds are even jumping into the party, which is a little bit dangerous. If you have a California pension, you might want to be a little nervous about it. So there still could be room to run. And usually it's when margin debt gets to be kind of a burden is when you start to see things head the other way. But I kind of keep following sage people like Buffett. And this is just a quote. This is from a book from Stanley Druckenmiller, who's a really, really famous hedge fund manager. If you're in the finance world, he'd worked at one time with George Soros and Jim Rogers, and then went off and did his own thing, his own fund. And he talks his experience in the year 99, 2000. And basically just saying, he wrote in on this thing, made 30%, or he wrote in on these and then he sold and it made 30% right after he sold. And then he saw, it kept going up and, it started to get to him. And then finally what he ended up doing was he kind of bought it. Probably he said hours after the bubble had reached its peak, and ended up costing them $3 billion on that trade for jumping back in. And it just said, it's, because I got emotional. And he said, I dropped every tool of discipline I ever had. Somebody says, well, what did you learn from it? I just said, I learned nothing. I learned that 25 years ago. You could talk about not being emotional, but it takes incredible discipline to act on that. So the big thing, this is just a reiteration. I'm talking to kind of the same thing I talked about last presentation. It's funny when I do kind of economic or investing presentations, they tend to get a little bit more traction than when I do a tax or a financial planning presentation, although those are extremely important. I had one client say, those tax presentations you do are kind of like castor oil, it's good for you and it's important, but man, you just don't like to take it in. And that's true, but we'll still try to do a lot of different topics. So again, as I mentioned in the previous presentations and stuff, there's value stocks and there's growth stocks. Value stocks are typically more mature companies that are very good at delivering cash flow to their investors. It's either that or it's a company that's been beaten down. So if a company drops substantially, it becomes a good value. So that's usually when you're talking value, those are what you're focused on. And then growth, as you can imagine, are companies that are just having faster than normal revenue growth. There's a lot of runway for them to capture market share, to increase their customer base. But usually with growth companies, they're struggling on cash flow. They're heavily indebted, and their profits are not really anywhere near what a value company's is. And you kind of just look at, let's divide, growth and value here. And you can kind of see the original top in 2000, how far growth had taken over compared to value. But then over the ensuing years, up until 2009, value outperformed substantially. And then what you had right now is we're kind of seeing the same thing, although at even higher levels. So is value going to have a resurgence? And at some point it is. Everything is cyclical. I don't know when exactly it's going to hit, but it does happen. So, is this a triple top for it? Is it going to eventually start to turn here? I don't know, but you can get some pretty cheap valuations in other sectors compared to the growth. And then international also offers extremely compelling valuations. This is just showing on the price to earnings, the discount versus the U.S. stock market. And, it's got about a 38% discount. Now, Europe, even parts of Asia, they're not as dynamic as the U.S. economy. Absolutely not. So the U.S. might always deserve a premium. And in Europe, they definitely don't have a tech sector, anything near what we have. Asia certainly has a very competitive tech sector, but maybe not on the leading edge. They're more of the industrial side of the tech sector. But still, you're talking about price to earnings. So the key thing there is earnings. You're getting earnings for your investment. A lot of it's coming from dividends, a lot of it coming from debt repayment and then repurchase of shares. So that's the biggest thing. This is just another slide kind of showing the same thing, how far we've gone as far as valuations relative to the international markets. So you can kind of look at the Nifty 50 back in the 70s, 60s, and 70s, when the Nifty 50, the 50 U.S. stocks that everybody had to own, when they were at their peak, relative to the international, U.S. was at its peak. And then the internet bubble, and again now, it's substantially higher. And then this is just yet another U.S. versus international, kind of shows you since 2007, international, especially emerging, hasn't really gone anywhere compared to the United States. Is that trend going to continue? It very well could. Will it continue forever? I just don't think it will. I just don't. Because nothing goes on forever. And there are cycles in the markets that always tend to happen. Okay. And then, of course, we always end with the lawyers say hello. So, so that's basically all I've got for this week. Again, a little bit shorter, but I was doing some traveling in middle of my last tax season here. So, didn't jump into it. Some other things on the radar that I'm going to be talking about. These are questions from clients. So along with the tech stocks, I get questions on Bitcoin right now because Bitcoin's doing the same thing that NVIDIA. They're both essentially doing the same kind of thing. And I've done presentations on Bitcoin. I did them back right after COVID. And there could be, we'll talk about this, but there could be a place for Bitcoin in your portfolio. But if Bitcoin doesn't start to really change, that's sort of being sold as a monetary unit, an alternative to the US dollar and other currencies, but it's got a lot of growing up to do. And it's, I don't see it happening anytime soon. So it's really right now kind of a speculative asset without any real intrinsic value other than the fact that they're not producing more of it. There's a set limit to it. But if that's the case, then you should probably see the Mickey Mantle rookie cards doing the same thing that Bitcoin is because they're not making any more of those and they're very limited. So the fact that something's limited doesn't necessarily make it valuable. There has to be value to it, intrinsic value. We'll talk about Bitcoin upcoming. We'll also talk some questions on just, retirement distributions. Everybody might have at some point heard about the 4% rule. I'm going to get into that. What is it really? And what if you're going above 4%? And how, when you first retire, you probably will be above 4%, and that's normal. We'll talk about some of those things. So yeah, that's basically all I've got. I don't see any other questions. So I'm going to let you guys, Bitcoin's the ultimate fiat currency. Yeah, you're probably absolutely right. And the thing is, I don't even think it could be used as currency because we'll talk about this more, but right now, most of the people that buy it say they'll never sell it. And if you have a currency that is not moving throughout the economy, what's that do to the economy? What's deflationary? When you don't have any velocity of money, you basically get a crash. You don't have economic activity. And also right now, if you were to go buy a car with Bitcoin, you could wake up and it could be down 30% in a day. And now all of a sudden that car is a lot more expensive for you. So it's got a long way to go if it were to ever become a currency. Okay, so I'll let you guys go. I hope you have a great weekend and hope your spring as we head into March, hopefully it'll go well. So have a great weekend, everybody. Take care.